Good morning, or perhaps good evening, depending on which time zone's candlestick chart you happen to be staring at right now. If you are accustomed to only watching the rise and fall of the Suchep Wubai, or if you only focus on the latest non-Jan farm payrolls, then you may have missed the quietest yet most deafening tectonic shift of this century. Just yesterday, a number was updated deep within the databases of the Federal Reserve and the US Treasury, Dubai Bashabadir billion USD. This is the total amount of US debt held by China. In the not Zan so Zan distant year of Nansani Yishusen, this figure was as high as 1 trillion USD. This isn't just a Bifendrasishitsi drop, it is more like a load Zan bearing pillar of the global financial architecture of the last half Zan century being quietly removed. Is this merely an ordinary balance sheet adjustment? Many analysts on Wall Street will tell you yes. They will say, oh, that's just to defend the exchange rate, or that's simply diversification. But if you open the overnight repurchase agreement data of the bond market, or carefully scrutinize the selling records from those specific months, the answer is clearly no. This is not an adjustment. This is a retreat. And it is a strategic retreat that has cost Zan insensitive, one might even say brutal. Why did we all misread this before? Because we are still using pure economic logic to measure a world that has already entered survival logic. Why sell at a loss? Let's first solve a problem that has plagued countless fund managers. If you hold tens of billions of dollars in bonds bought when interest rates were extremely low, and now rates have risen significantly, what do? The standard textbook answer is hold to maturity. As long as you don't sell, the loss is just a number on the books. As long as the US Treasury doesn't default, you will eventually get your principal and interest back. However, look at the data. In October, Nanshanlin Arshawul alone, China sold off Shiyu billion USD in the following March and April. Another nearly Sencha billion USD left the table. Why would China willingly lock in these losses? Why turn paper losses into realized losses? Exactly when prices are at their most depressed. Do those top financial bureaucrats in Beijing not understand basic bond mathematics? Quite the opposite. They understand it too well. This anomalous behavior itself is the biggest signal. When a rational investor is willing to accept a certain massive financial loss just to get their capital out. What does that mean? It implies that in their risk model, the probability of not getting the principal back has exceeded the pain of book losses. We usually focus on return on capital, but in this new era, for creditors holding massive amounts of US debt, the core consideration has shifted overnight to the return of capital. When US treasuries, once viewed as the safest asset on the planet, start being tagged with geopolitical risk, their valuation logic collapses completely. This is not simple duration management. This is a repricing of asset safety. China, Zhongguo, is paying an expensive insurance premium in exchange for extricating itself from a system it deems increasingly dangerous. The Shutsi Zan year cycle and the end of an era. Why Liu Bai Bashabadir billion? Why a Shutsi Zan year low? Let's pull the timeline back Shutsi years. That was around Laocenin Ba or Laocenin Zhou. That was when the global financial crisis was raging, and also the starting point for China to massively increase its holdings of US debt, acting as the buyer of last resort for global liquidity. That era was known as the honeymoon period of Chimerica. China produced cheap goods, exchanged them for dollars, and then used those dollars to buy us treasuries, suppressing us financing costs so that American consumers could continue borrowing to buy Chinese goods. It was a perfect closed Jan loop perpetual motion machine. Wasn't it beautiful? But does that mean this cycle could last forever? Obviously not. The appearance of the number Liu by Bashabadir billion declares that this nearly Arshur Zan year cycle has formally snapped. Is the timing of this event a coincidence? Not at all. Look at the current macro environment. The scale of US debt is exploding exponentially, with interest expenses exceeding the defense budget. Meanwhile, financial sanctions and asset freezes targeting specific countries have become normalized diplomatic tools. If you were the world's largest creditor, and you saw your debtor frantically printing money to dilute the value of your claims, while simultaneously sharpening knives under the table, ready to freeze your accounts at any moment, what would you do? Would you wait until the crisis completely erupts to run? No. By then, the door will be too narrow, and you won't be able to squeeze through. You must start leaving quietly and firmly while the music is still playing and everyone else is still dancing. This is why, even in months where US Treasury yields seem attractive, the selling continues. This is not a trade based on the yield curve. This is a judgment based on historical cycles. It marks the switch of global capital flows from cooperative mode to defensive mode. What does this mean for the ordinary investor's wallet? Maybe you will ask, okay, this capital game between two great powers, what does it have to do with me? I'm just dollars and cost averaging into index funds or paying off my mortgage. Is this really a case of gods fighting while mortals watch the show? I'm afraid your wallet is already in the center of the battlefield. Please remember the first law of finance. The US Treasury yield is the anchor for global asset pricing. If you buy a house, your mortgage rate is calculated based on the US Treasury yield plus a spread. If you invest in stocks, the denominator of the company's valuation model is also based on the risk and free rate. For the past 20 years, the reason your mortgage rate could stay low, and the reason tech stocks could enjoy P ratios of dozens of times, was largely because there was a super buyer continuously buying us debt, artificially suppressing the global cost of capital. Now, the super buyer has not only stopped buying, but has started reverse selling. Think about it. When the biggest buyer becomes a seller who will take over, the Federal Reserve, that means more violent inflation. US pension funds, their capital is limited. This leads to a terrifying transmission mechanism, supply and demand imbalance. The market is flooded with offloaded treasuries, causing bond prices to fall and yields to soar. Asset revaluation, the permanent elevation of the risks and free rate, means the valuations of all risk assets must be forced downward. Inflation stickiness, to digest this debt, the purchasing power of the dollar will be forced to dilute. The cash in your hand is having its purchasing power quietly evaporated in the friction of this great power game. This is no longer a question of how much GDP will grow next quarter. This is an obituary for the era of cheap money. Do you think inflation is just eggs getting more expensive at the supermarket? No, real inflation is the restructuring of the asset price system. When China is no longer willing to finance the US deficit, every ordinary person holding us dollar assets is actually being forced to share this massive cost. This is an invisible tax, levied on everyone in the world who relies on the dollar system. When the biggest elephant in the room decides to get up and leave, the floor will surely shake. But after the tremor, you will discover an even stranger phenomenon. The party didn't stop immediately. China is throwing sell orders worth tens of billions of dollars at the market every month. Yet the US Treasury market didn't collapse in a single day. Why? Is it because the US economy is strong enough to absorb it all? Or is there an invisible hand quietly swapping cards under the table? In this chaos, who is shorting? Who is profiting? More importantly, who is catching this falling knife? If you think this is just the natural adjustment of market supply and demand, then you may have underestimated Wall Street's greed and overestimated the system's resilience. Let's take a look at the current list of buyers. In the past, who held us debt? It was central banks, sovereign wealth funds, and real money with long-term strategic determination like China. They bought for reserves and usually held to maturity, unshakable. And now, as China retreats, who has rushed in? Data shows that the holdings of the household sector and hedge funds are surging, especially hedge funds. They are playing a game called the basis trade. Isn't this a good thing? As long as someone buys, isn't it fine? Absolutely not. This is swapping a granite foundation for quicksand. Hedge funds are not there to earn that 5% or 5% interest by holding government bonds. They are utilizing extremely high leverage to arbitrage the tiny price difference between Treasury spot and futures. This constitutes a massive, hidden systemic risk. What China used to provide was unleveraged long-term liquidity. What the current bag-zan holders provide is highly leveraged, speculative liquidity. It's like a building originally supported by steel beams, now being held up by cardboard glued together with superglue. It looks fine normally, but the moment the market feels the slightest breeze, such as a sudden spike in repo market rates or a jump in the volatility index, these hedge funds must liquidate instantly. That kind of collapse won't be a slow slide, it will be an instant vacuum. So, when we see China reducing its holdings in an orderly manner, we are seeing not just a transfer of ownership, but the disappearance of the global financial safety cushion. In this process, certain shrewd money on Wall Street is making a fortune from this volatility, but they are dancing on the rim of a volcano. When the dollar becomes a weapon, who dares to save money? Do the White House and the Federal Reserve not know the consequences? This is a question that keeps countless macro strategists awake at night. Of course they know. Ms. Yellen knows better than anyone that when the U.S. fiscal deficit grows by trillions annually, she needs every possible buyer. But there is an irreconcilable variant of the Triffin dilemma here, the weaponization dilemma. For short, term geopolitical victories, the U.S. chose to weaponize the dollar settlement system and U.S. Treasury assets. Think back to what happened 2 years ago, when the GTC froze approximately 10 billion USD of Russia's foreign exchange reserves overnight. That signal was more shocking to policymakers in Beijing, Riyadh, and Brasilia than a nuclear bomb. This move broke the financial world's sacred contract. Private property is sacred and inviolable, and sovereign reserves are even more inviolable. If you were an asset manager in China and you saw your neighbor have their money confiscated by the bank because they had an argument, what would you do? You would do everything possible to withdraw your money from that bank, even if you have to pay high fees, even if you can only exchange it for heavy gold bars to bury in the backyard. This is what China is doing. This is not simple accounting. This is the deeds and risking of the national balance sheet. The US is trapped in a doom loop. The more it uses dollar hegemony for sanctions, the more eager other countries are to get rid of dollar assets. And the more other countries sell, the more the US has to maintain high interest rates to keep the debt running, which in turn exacerbates its own interest burden, even triggering banking crises. That is why I say this is not a portfolio adjustment. This is a bank run on trust. This is not just stagflation. It is a slow-down motion replay of the sterling moment. Is history rhyming? Many people like to compare the current situation to the stagflation of the Chimerica. But I think this is more like a slowed-down motion version of the decline of the British pound's hegemony in the first half of the RT8th century. You will often hear the dollar collapse theory. It sounds sensational, but it is inaccurate. The currency hegemony of a great power won't suddenly drop dead on a Tuesday afternoon. How long did it take for the pound to lose its crown? From the end of World War I to the Suez Crisis in Egypt, it took a full 6 years. It is a chronic, suffocating decline. China reducing us debt is not to destroy the dollar. That would hurt China itself. China is building a parallel system. Look at how clearly this hand is being played. Left hand, selling us treasuries. Right hand, buying up gold like crazy, stockpiling copper ore, oil rights. This is not just swapping positions, this is redefining what wealth is. In the past version of globalization, iedereen, wealth equaled dollars. In the forming version of globalization, iedereen, wealth equals energy, resources, and productivity. China is using the US government's iOS to exchange for real, tangible resources on this planet. In this process, the dollar won't disappear, but it will gradually degenerate into an ordinary regional currency, no longer enjoying exorbitant privilege. This is Wall Street's most feared nightmare. Not that the dollar turns into scrap paper, but that the dollar becomes mediocre. Once the dollar becomes mediocre, the magic trick where the US can print money to exchange for the world's goods can no longer be performed. We have uncovered the secret. Under the table, unstable speculative capital is replacing stable sovereign capital. Political weaponization has led to a collapse in financial trust, and the world's second and largest economy is taking practical action to quietly switch from a dollar standard to a resource standard. It sounds grand, perhaps even distant, but make no mistake, the flapping of this butterfly's wings is about to trigger a hurricane in your life. Let's bring this down to the most realistic level. If this decoupling continues to accelerate, what will happen in the next Chimerica? As ordinary people, in this era of the return of hard assets, how do we avoid becoming cannon fodder? As we said at the beginning, the divestment by the world's second and largest economy is not a simple news headline, but a starting gun. It signals that the escalator model of just buy and hold to get rich of the past 6 years has completely stalled. Now, you are standing in an unknown wilderness. There are no ready-made maps. If you don't want to become the cost in this great upheaval, you must learn to think like the sharks that survive crises. Which dashboard should we watch in the next Chimerica hours? If a sell off of this scale continues to accelerate, or even evolves into a panic stampede, where is the tipping point for a crash? This is the billion-dollar question. Many people will habitually stare at the site P Wubai or the Nasdaq. Wrong. When the stock market starts to crash, that is already the result, not the signal. Reacting then means you've already lost. If you want to be half a step ahead of the market, you need to stare at the water pressure gauge buried deep at the bottom of the financial system. In the next Chimerica hours, as an observer, please lock your eyes on the following 3 extremely boring, yet life-Jan or Jan death indicators. First, the real yield of the Jan-year US Treasury. Don't just look at nominal rates. If nominal rates soar but inflation expectations also soar, that is still considered mild. What is truly terrifying is the loss of control over real rates. Once the Jan-year tips yield quickly breaches Wu or even Sen, this is the system's melt-Jan down point. It means borrowing costs have become so high that no entity in the real economy can generate enough cash flow to cover the interest. When this number spirals out of control, the Federal Reserve will be forced to intervene, printing money to save the market no matter how high inflation is. That moment is the point of total collapse for currency credit. The MOVE Index. You can understand it as the panic index for the bond market. Deduction, as long as the MOVE Index oscillates at a high level above Yoarlean. It indicates that those hedge funds leveraging Wuxia X mentioned in Part R are on the verge of blowing up at any moment. If the MOVE Index suddenly shoots up vertically, it means the repurchase market has dried up. At this very moment, cash is king. According to traditional logic, when the dollar is strong, gold is weak. But if in the next few days you see the dollar index rising while gold is also hitting historical highs, please sound the highest alarm in your mind. This means the market no longer cares about the relative price of exchange rates, but is collectively fleeing the concept of fiat currency itself. This is the ultimate signal of a systemic crisis of trust. Within these Chimerica hours, Don't watch the news broadcast, watch these three indicators. If they flash red simultaneously, then no matter what you are doing, protect your liquidity first. Is it time to hold cash? Or embrace physical objects? Caught between currency devaluation and asset crashes, is there any way out for ordinary people? This is an extremely cruel game. If you hold cash due to the inflationary backlash triggered by China's selling of US debt, your purchasing power is shrinking at a rate of 500 Wu per year. If you hold assets due to high interest rates, valuations face the risk of drastic downward revision. This is an era where cash is toxic and assets have thorns. So what is the smart money doing? The answer is the barbell strategy. Please abandon the traditional stocks and bond balance strategy. It has failed in this new era. You need to allocate between two extremes. The middle ground is the death zone. One end is extreme liquidity. You need to hold short and term treasury bills or highly liquid cash equivalents. Why? Because in the instant a crisis erupts, cash is the most expensive asset in the world. You need this money to pick up bloods and stained chips when others are forced to sell. Do not lock up this money in longs and term fixed deposits at this time. The other end is extreme hard assets. You need to allocate to things that cannot be printed. When the US cannot find buyers for its debt, its only way out is to devalue the dollar in default via inflation. Under the logic of longs and term inflation, gold, energy stocks, scarce real estate in core cities, and even Bitcoin are essentially anti-Zan fiat options. Note, this is not about speculating for profit, but about hedging against the risk of fiat credit going to zero. Advice for debtors: if you have fixed loads and interest debt, congratulations. In an era of inflation, this is your best asset. Inflation will help you dilute the real value of the debt. Never rush to prepay, that is sending precious cash back to the bank. Advice for workers: in this period of extreme volatility and return on capital, your best human capital hedge is to make yourself possess irreplaceable productivity. In stagflationary depression, unemployment is more terrifying than inflation. What is the end game of all this? Will the world be destroyed? Of course not. The world won't be destroyed, but it will split. China reducing us debt is just a milestone in this splitting process. We are bidding farewell to the great moderation of the past 6 years, that beautiful old world of globalization, low inflation, low interest rates, and seamless supply chains. We are entering an era of the great game in this new world. Financial logic will submit to security logic. The global financial market will split into two parallel systems. One is the Western system based on the dollar-euro, and the other is the Eastern-Southern system based on commodities resources. The free flow of funds between these two systems will become increasingly difficult. You need to pick a side or pay a high toll fee. The end game of investment, the era of winning by lying flat with passive investment, is over. Future excess returns will come from a profound understanding of macro-Zan politics and the precise capturing of cyclical fluctuations. The biggest risk is not losing money, but the rigidity of cognition. When you look at the number due by Bashabadar and C billion, do not see it as a distant statistic, view it as a notification slip. The old contract has been torn up. New rules are being established on the ruins. In this massive reshuffle, no one can guarantee you will win. But at least through this long article, you have seen the situation on the table clearly, seen who is cheating, and seen where the exit is. That is enough in this era of a blind man riding a blind horse. Clarity is the greatest privilege.